Myles, I do want to talk a little bit about what the earnings picture looked like. We pretty much just, excuse me, wrapped up the fourth quarter results. And, in some ways, maybe a little bit better than feared, but it does look as though there has been some deterioration in terms of quality. How do you assess what we've seen in the United States? And of course, we've also just wrapped up the big bank earnings here in Canada. So what's the takeaway?
Earnings are definitely under pressure. You see, as you said, the U.S. just wrapped up its earnings quarter reporting season, and earnings for the S&P aren't down all that much. I think it's close to like 3%. Earnings are down, but the point being is that margins are now under pressure. The economies are slowing, costs remain elevated, and you're seeing this growth slowdown, earnings growth slowdown, not only in the U.S. but you're seeing it all around the world. And here's sort of the issue. If right now, when you look at analysts' expectations, earnings are expected to be about flat this year. Now that's come down quite a bit. Not too long ago, we were talking about 7, 8, 9, 10% growth for 2023. Now it's about flat. So expectations have come down. But if you do get a little bit more of a downturn in the economy, which is what a lot of the leading economic data is saying, you could see earnings down 15 to 20% in the U.S. and globally. And to me, that suggests, when you have flat expectations, that there is room for earnings disappointment on a go-forward basis.
That's a significant amount, though, Myles, particularly, given the fact that, to your point, we were looking for up 7, 8% or so not that long ago. I really don't think that the market is anticipating at all that we could be down 15 to 20% on a year-over-year basis. What kind of damage would that do you think, to the multiples?
I completely agree, Kat. I don't think the market is prepared for down 15%. Now, down, if we got sort of a plain vanilla downturn in the economy, earnings are usually down 20%. So, I'm saying 15 to 20. That's what most of the leading macro data tells me. So could that mean, more turbulence for the markets? I think so, because I don't think the equity market is quite ready for that type of earnings downturn. And you're seeing it also in the corporate bond market. I mean, the corporate bond market corporate spreads have come in, high yield spreads, investment grade spreads, they've all come in. So, the markets themselves had been bracing for, let's call it a softer landing. But now with this extra tightening that's being pushed into the system, maybe we get a little more serious of a downturn than what is currently being expected.
When you think of this year and you think back in terms of all the years that you've been managing money, what do you liken it to? And I say that in the sense that my view of how we entered 2023 was that there is going to be this push and pull between the market and its expectations of what the U.S. Federal Reserve and the BOC will or will not do. And that it's almost as though we're just setting ourselves up for these, trading opportunities, if you want to call them that. I think that it's just going to be, choppy quarters in 2023. And that if you want to kind of try to make money, it's going to be from a trading perspective, but you're probably much more of a longer term investor. So, do you sell some of your winners when they rise and then look for opportunities at the bottom? What do you liken this to?
Well, there isn't a lot of, in my 30 years, there isn't a lot of parallel experiences to this. I mean, we haven't seen, now the whole point is, we're walking into, this is a setup that's been sort of driven by 15 years of 0% interest rates, and 0% interest rates have sort of been driving investor decisions. And now we're walking into a period where we don't have 0% interest rates anymore and everyone has to adjust. So this is, I can't liken this to anything I've seen before. Now, like you say, I think it's going to be a volatile environment. We're going to have to adjust to higher interest rates and maybe some rocky sort of road ahead for earnings. So I think it will be, this ebb and flow between, maybe inflation's improving, but maybe growth is getting worse. And we're going to be doing that back and forth a little bit. And so I think this does set up for somewhat of a choppy environment going forward.
So Myles, it's definitely been, I think, a challenging year to start. We're not even very far through it yet. But what I guess bottom line is your advice to people, and there's still a lot more to talk about, but how should people really be thinking about positioning themselves for this year?
You know, I think this is going to be a year for traders. So people with longer term investments, longer term horizons are just going to have to sort of wait, be patient, and sit through this and ensure that, they have enough income to keep them going on a go forward.